Welcome back to the CFO Strategy Brief. I'm your host for today. My name is Paul Hunter. Today's episode is about a gap that sits right at the heart of most large organisations, and almost nobody names it properly. It is the strategic governance divide, the structural gap between how strategy is created and how it is governed. On one side of that divide, you've got the CEO and, where it exists, the Chief Strategy Officer, or CSO. Their job is to imagine futures, design business models, and choose where the company wants to play. On the other side, you've got the CFO. Their job is to govern how those strategic choices are made, tested, funded, and renewed. The problem is that in most companies, the CFO's role on that second side is either underpowered, underspecified, or completely invisible. You're held personally accountable for critical capital allocation and financial integrity, but nobody has given you the language or the systems to govern strategy itself. Today, I want to do three things. First, describe the strategic governance divide in plain language. Second, show how your governance posture needs to shift as the organisation moves from formulation to implementation, then hopefully onto regeneration. And third, introduce three different kinds of intelligence you need to govern: strategy intelligence, strategic intelligence, and organisation intelligence, and why confusing them is a recipe for governance failure. Large companies actually behave. A pattern jumps out. In our research, we examined 30 companies drawn from the top 100 of the Fortune 500 across financial services, tech, retail, energy, healthcare, automotive, and consumer goods. We asked ourselves a very simple question. When does strategy show up? Not what is the strategy, just when does it appear in a systematic way? The answer is astonishingly consistent. Roughly 85% of these companies follow the same rhythm. Q4 is when the real strategy work happens inside the firm. Business units submit plans, the centre arbitrates, budgets and capital allocations are locked down. For US companies, Q4 is January and February. This period is the stage for Q4 earnings reports, the period where strategy goes public. The story is told, guidance is set, investors hear the forward narrative. The rest of the year is basically commentary. Each quarter's results are measured against whatever narrative was launched at the start of the year. Different sectors decorate this pattern differently. Banks with investor days in May, energy companies with November corporate plans, retailers with April strategy days, and healthcare with big December conferences. But the underlying habit is the same. Strategy is treated as episodic, as though it was a season. And here's the critical finding. We did not find a single company that had operationalized a genuinely continuous strategic intelligence system. There were plenty of quarterly earnings calls, annual investor days, annual meetings, ad hoc announcements. But between those set pieces, boards got execution reports. They did not get a live view of whether the strategic logic itself was still valid. Strategy is conducted annually. Competition happens daily. That is a strategic governance divide in practice. So who is naturally positioned to close that gap? The answer, whether organisations have admitted it or not, is the CFO. Let's now define the strategic governance divide in plain language. On one side, you have strategy creation. That's the CEO, and where it exists, the CSO. Their job is to answer the question, what do we want this company to become? To design portfolios of businesses, capabilities, and increasingly human-machine systems. To make calls on technology, architecture, data strategy, and ecosystem participation, and to tell a coherent story to markets, employees, and regulators about where the company is going. That's imaginative work. It's outward-facing, future-oriented, narrative-driven. It's about prospection and invention. On the other side, you have strategy governance. That's where the CFO comes in. Your job is not to be the strategist, it's to answer a different set of questions. What assumptions are we making about markets, technology, regulation, and competitors? Have we explored multiple scenarios, or are we betting the company on one untested narrative? How much capital are we committing, over what time frame, and with what exit options? Under what conditions would we pause, pivot, or walk away, and how will we recognise those signals early? Are we building regeneration capacity, or just cutting costs? In other words, the CEO proposes, the CFO governs, and the board adjudicates. When that structural separation is clear, the tension between creation and governance is productive. The CEO can be bold. The CFO can be demanding. The board can see the trade-offs. When it's not clear, two things tend to happen. Either the CEO tries to both imagine the future and stress test every assumption and ends up paralysed, or the CFO is told strategy is the CEO's domain and backs away from governance, and you end up with untested assumptions priced into the share price. We've seen the consequences in places like GE, where boards and CFOs tracked the numbers but did not govern the coherence of enterprise strategy. And in Fortescue Metals, where a bold green hydrogen play wasn't governed, the kind of scenario work that would have surfaced value destruction risk earlier. The strategic governance divide is simply recognising that strategy creation and strategy governance are two different jobs, and that the CFO has a dual role: traditional financial stewardship as the first, second architect of the discipline around strategy. Next question: how does that dual role play out along the strategy journey? For CFOs, the strategic governance role is not static. It needs to shift emphasis depending on where the organisation is in its transformation and renewal journey. Let's look at 3 stages of that renewal journey. First is strategy formulation, deciding what we're becoming. Second is strategy implementation, reallocating, restructuring and building. And third is strategic regeneration and subsequently organisational regeneration, time when the organisation is renewing from strength, not crisis. In formulation, the organisation is asking, what do we want this company to become? The CEO and strategy team are exploring futures, designing options, talking to markets. The CFO's governance role at this point is principally as question holder and assumption challenger. The questions the CFO needs to insist on are as follows. As examples, anyway. 1. Are we exploring a wide enough range of futures, or have we anchored prematurely on one narrative because it's emotionally appealing? Second, do we have genuine downside and stress scenarios, or just a base case with some sensitivities around the edges? 3. What are the small number of critical assumptions that make up this strategy work, and how would we know early if they're wrong? 4th, are we committing capital after that work is done, or are we letting restructuring start before reframing is finished? The governance risk at this stage is premature closure. If you start committing billions to a direction before the intellectual work of reframing is complete, you end up cutting costs without knowing what you're cutting towards. 18 months later, you're cutting again. The balance sheet is thinner, but the strategic fog hasn't lifted. That's how companies slide into repeated restructuring cycles without ever truly changing who or what they are. The CFO's job in formulation is to insist that board sees evidence that the reframing is done, or at least robust, before large, irreversible commitments are made. Once the strategy moves into implementation, reallocating capital, pruning non-core businesses, investing in new capabilities, the CFO's governance emphasis shifts. Now, the CFO becomes visibility enabler and resource system steward. The questions change. Is capital allocation actually aligned with what we said we would do? How much capital is going to sustain the current business? How much to strengthen it? And how much to disrupt and seed the future? Are we clear on restructuring must hand off to revitalisation when we stop dismantling and start building the new? If the reframing work wasn't done properly before restructuring started, the organisation will hit a boundary it doesn't know how to cross. You'll see a lot of cost-out work and portfolio pruning, but no real revitalisation. Margins improve for a while, and then the underlying competitive position erodes and the next crisis hits. On top of that, as more of the resources base becomes computational, AI models, automation platforms, robotics, data architectures, you need to govern resource agility. Can we repurpose these models and platforms if the strategy changes? How hard is it to switch vendors, architectures, or ecosystems? Are we building firm-specific human-machine systems or just buying the same tools as everyone else? In implementation, your governance job is to give the board clear sight of resource flows and agility, so they can see whether the declared strategy is actually being resourced and how locked in those resource choices really are. During the third phase of regeneration, it is the most misunderstood aspect of strategy and the most important. Regeneration is not a final destination. It's an operating mode where the organisation is continuously sensing and reframing, periodically restructuring from strength, not panic, constantly revitalising the core, whilst deliberately building the next wave of businesses and capabilities. CFO governance emphasis here shifts to protecting and governing renewal capacity. Examples of questions to be asked here are as follows. 1. Do we have a visible green shoots portfolio where experiments, adjacencies, deliberate disruptions are explored, with protected funding and stage gates well understood? 2nd, is that portfolio expanding or quietly shrinking whenever earnings pressure rises? 3rd, are we tracking and revitalising assumptions that lie behind our major bets as a matter of routine or only when something goes wrong? And 4, when we say we are in transformation or regeneration, do the actual resource allocation patterns support that, or do they look like crisis-driven cost-cutting? The governance test here is sharp. If the company claims to be in a regeneration journey, but the numbers show most capital going into sustaining the core, with green shoots starved of resources, you are not regenerating. You are doing episodic restructuring, just with better branding. In regeneration, your job is to make sure the board can see the difference in the numbers, not just the narrative. Next, I want to add a second lens, which I think is critical if you're going to own this governance role as the CFO. Increasingly, we're throwing the word intelligence around a lot, especially with AI everywhere. But inside organisations, intelligence actually comes in 3 different flavours. They sound similar, but they're not. And if you treat them as the same thing, governance breaks down. 3 of the intelligence areas we've identified are as follows. They are strategy intelligence, strategic intelligence, concept informed by strategy intelligence, and organisational intelligence. Let's start with strategy intelligence. It's the machinery of governance. It is the one you're probably closest to already. It's inward-looking and process-oriented. It's about the quality and discipline of the strategy and the process of strategy itself. In this context, capital allocation by strategic intent occurs. How much is sustain? How much strengthen? How much disrupt? Portfolio management and resource prioritisation takes place. Scenario modelling and financial stress testing follows. Assumption tracking, documenting what we believed when we made the decision, is assessed. Decision gate enforcement, assessing what has to be true before we move from pilot to scale. And resource deployment mapping, understanding who and what is tied up where. Strategy intelligence answers the question, is our strategy process and or system functioning with appropriate rigour, and are our choices being governed? Most large companies have some of this machinery. The problem lies in cadence and scope. The problem with cadence is it's typically geared to the annual ritual we've described above. Problem with scope? It monitors execution, not whether the underlying strategic logic still holds. The CFO's job, therefore, is to upgrade strategy intelligence so that it runs continuously, not once a year, and so that it includes the assumptions and scenarios, not just budgets and variances. Next is strategic intelligence, where we sense the outside world. It's not the same as strategy intelligence. It's outward-looking and future-oriented. Strategy intelligence is the opposite. It's the organisation's ability to sense, interpret, and respond to what's changing, Markets and competitors. What's changed? Technology and regulation. What's about to change? What might change? What do we know about what we don't know about technology change? Geopolitics and society is another element. Ways of managing this include horizon scanning, weak signal detection, scenario design, competitive analysis, and stakeholder foresight. Most of that process belongs to the CEO, the strategy team, and specialist units, competitive intelligence, market research, technology scouting, all less mainstream but still important intelligence gathering capabilities. The CFO's governance role here is to make sure strategic intelligence actually reaches decision makers and that it is stress tested through scenarios. It is translated into specific assumptions and it is monitored over time. In a lot of organisations, strategic intelligence is strong somewhere. There are brilliant deck writers in strategy, smart analysts in competitive intelligence, but almost none of it is wired into the CFO's machinery. The sensing function and the governing function live in parallel universes. That is what has to change. The third form of intelligence, organisation intelligence, is about organisational intelligence and organisational learning. It is the basis upon which regeneration takes place of the core assets. Organisation intelligence is not a department or a system. It's a property of the whole organisation. It's the collective capacity to do a number of things. For example, integrate formation from multiple sources into coherent action. Detect and respond to local signals without waiting for central instructions. Learn from experience and embed that learning into standard practice. And maintain strategic alignment while allowing operational autonomy. If strategy intelligence is the machinery and strategic intelligence is the sensor suite, organisation intelligence is the nervous system. In our research, we saw almost no company that had operationalised this as a governed capability. Innovation portfolios existed, but were governed. Lessons were learned in pockets, but not systematically embedded. Local sensing existed, but did not roll up into an enterprise-level view. And this matters because organisation intelligence is what separates companies that genuinely regenerate from companies that simply restructure over and over again. Let's take a little time out to understand why this distinction between the CSO and the CFO actually matters in the real world, not just on an organisation chart. A quick look at today's C-suite landscape makes the distinction very clear. Our review of the largest Fortune 500 companies indicates that roughly 3/4 do not have a dedicated Chief Strategy Officer on the top team. Where that is the case, strategy governance is even more dependent on the CFO than is usually acknowledged. 3 patterns of role configuration in corporate strategy governance stands out. First, where no CSO exists, the CFO is typically the most senior executive with both the analytical capability and the board mandate to challenge strategic assumptions. In these organisations, the institutional dialectic between strategy creation and strategy governance collapses unless the CFO consciously steps into that governance role. Second, where a CSO role does exist, the governance question shifts. The CSO leads formulation, but who owns the rigour, the assumptions, and their renewal capacity that stands behind those choices? In practice, it is still the CFO. General Motors, the automotive company, makes this explicit. Its new strategy leader reports to the CEO on strategy and to the CFO on corporate development and capital deployment. This structurally separates strategy creation from strategy governance while forcing them to work together. Third is interesting, there's a growing trend toward dual-hatted strategy roles. In this pattern, organisations deliberately connect strategy formulation with transformation, execution and financial governance in a single and bridging role. The model this podcast has been advocating all along. General Motors again, its Deputy CFO VP Strategy is one example. Others include PepsiCo's Chief Strategy and Transformation Officer and United Health's Chief Strategy and Growth Officer, which explicitly combined forward-looking strategy with growth and change execution. All of this reinforces the central thesis of this episode. If 3/4 of the largest companies have no dedicated strategy executive, the CFO's governance role is not optional. It is, by default, the only game in town. Now it's important to bring those ideas together. Because the risk with CFOs is to conflate them, a CFO who focuses only on strategy governance, process discipline and capital allocation, for example, may miss the weak signals that a dedicated strategic intelligence function would surface. Machinery is running, but it is running on stale assumptions. A CFO who sponsors powerful strategic intelligence tools but ignores organisation-wide learning may find that insights are generated but never acted on. The sensing is working, but the organisation cannot respond. And an organisation that claims to have strategic intelligence capability but lacks the governance infrastructure to turn it into tested assumptions and governed decisions, that is intelligence without governance. That's how the CFO ends up with multi-billion-dollar write-downs and value erosion. The sensing may exist somewhere in the system, but governance never connects to it. So the punchline for this segment is this. The CFO has to govern all three, directly owning strategy governance, ensuring the strategic intelligence actually reaches governance, and sponsoring the organisational learning systems that make the whole enterprise smarter over time. To conclude, let me leave you with 4 takeaways. First, the annual strategy ritual is nearly universal and embedded. Q4 planning, Q1 narrative, quarterly commentary. It's not going away, but it cannot be the only moment when strategic logic is revisited. The world moves faster than once a year, and your governance cannot be tied to the investor relations calendar. Second, the strategic governance divide is real. The CEO and CSO create strategy. Your job is to govern how those choices are made, tested, funded, and renewed. That role has to shift emphasis along the journey, from question holder in formulation to visibility enabler and resource system steward in implementation, and to protector of renewal capacity in regeneration. Third, intelligence is not one thing. Strategy intelligence, strategic intelligence, and organisational intelligence, and all those other forms of intelligence that lie underneath it, serve different purposes, run at different speeds, and require different governance attention. If the CFO only governs one of them, they create blind spots. Their mandate, if they accept it, or your mandate, if you accept it, is to govern all three. And fourth, the companies that get this right won't just have better strategies. They'll have strategies that are transparently governed, continuously renewed, and backed by an organisation that can sense, learn, and adapt from strength, not from a crisis. That's our argument. Strategy governance belongs on the CFO's desk, not as an afterthought, not as a committee, but as a core responsibility, with the tools, the visibility, and the mandate to make it work. Thanks for listening. This has been the CFO Strategy Brief. If you found this episode useful, please share it with colleagues, especially someone who's wrestling with how to govern AI, robotics, or big transformation bets. You'll find companion white papers and resources at smiknowledge.com, phsnl.com, and csosandbox.com. Until next time.